Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Welcome to Fairport Flash. My name is Rick D'Amico, Manager of Investments at Fairport. As part of the investment team, my primary responsibilities are managing the firm's fixed income assets and liquid alternative investment strategies. Today, I'd like to discuss what's changed since the last time I spoke back in March, specifically in regards to the potential changes in Federal Reserve policy and the sharp drop we've seen in Treasury yields. So let's get started. If you can recall, in our last podcast, we discussed how the Fed, in Chairman Powell's words, had adopted a much more patient approach. At the time, the Fed funds futures market was not pricing in any additional rate increases or rate cuts in 2019, and it appeared as though the market was comfortable with the Fed's wait-and-see approach. Needless to say, a lot has changed in the past couple of months. Back in February, many economists held the belief the Fed was simply taking a pause in the current rate hiking cycle, with possibly one more rate increase in 2020 to bring the Fed funds rate more in line with the FOMC's longer-term target of 2.75%. Today, many analysts are now viewing last December as the final rate increase during this cycle. The market is now fully pricing in 2 rate cuts in 2019, with the first cut coming as soon as the July 31st FOMC meeting. In fact, Fed funds futures markets currently imply an 82% chance of an interest rate cut at the July meeting. While this may seem like a short amount of time between cycles, as Cornerstone Macro points out, it is not atypical for Fed policy expectations to change this quickly. If you look at the period from 1970 to 2008, the average time between the last rate hike and first rate cut has been just 5 months. So a July rate cut would put us at 7 months, slightly longer than the average between cycles, but well within the norm. So how did we get here so quickly? First, economic growth has slowed, both globally and domestically. The J.P. Morgan Global Manufacturing PMI is now in contraction territory for the first time since 2012. In the United States, the ISM Manufacturing PMI, while not in contraction territory, is down sharply from its November reading of 58 to 52.8. Running estimates for Q2 GDP have dropped as well. The Atlanta Fed GDP Now and New York Fed Nowcast estimates for Q2 have fallen to 1.39% and 1% respectively. Another cause for concern is the inverted yield curve. The U.S. 10-year minus 3-month yield curve remains inverted. According to Evercore ISI, historically, to signal a recession, the yield curve needs to be inverted by 15 basis points for 10 weeks. We are not quite there yet. However, it is worth paying attention to, as the yield curve has now been inverted by 21 basis points on average over the past 3 weeks. Fed Vice Chair Rich Clarida recently stated that the yield curve inversion is something he would take seriously if it persists for some time. Of course, the tone of the bond market, which had been fairly upbeat, changed significantly when President Trump announced that he would impose tariffs on Mexico to reduce the flow of immigrants. And while the tariffs have been suspended, the bond market is not quite sold on the deal, as market expectations for rate cuts have barely budged since the announcement. The last factor I would like to discuss is inflation, which is both low and still slowing, giving the Fed additional cover to cut rates if it so chooses. The core PCE, the Fed's preferred gauge of inflation, is estimated by Evercore ISI to slow to just 1.5%, well below the Fed's 2% threshold. So assuming the Fed does cut rates at some point in 2019, what would an easing cycle mean for the equity markets? Historically, when the Fed has cut rates, market performance has been mixed. During the rate cut cycles of the 80s and 90s, consumers took advantage of falling interest rates by taking on additional debt, which led to stronger earnings and propelled the equity markets higher. In 2001 and 2007, the easing cycles occurred during recessions, and these rate cut cycles coincided with a sell-off in the equity markets. So looking back, it's difficult to draw a conclusion as to what the first rate cut could mean for equities, as equity performance has been more tied to the actual environment in which the rate cut occurred. That is, either in response to a recession that was actually underway or in response to fears of a recession. According to Cornerstone Macro's research, the market implied probability of a recession currently sits at 37%, which is elevated but not quite yet at alarming levels. Let's move our attention to the fixed income markets. 10-year Treasury yields at 2.11% have dropped over 50 basis points since our March flash, trading as low as 2.05% and decisively breaking through several key support levels on their free fall. From a technical standpoint, the next key support level to watch is 2%. Fundamentally, if the Fed does remain on hold, fair value on the 10-year Treasury is close to 2.3%. However, if the Fed does cut rates 50 basis points this year, from 2.5% to 2%, according to Roberto Perli from Cornerstone Macro Research, fair value would be closer to 1.8% after accounting for the negative term premium. So while the trend appears lower with regards to interest rates, Treasury yields at 2.11% are trading near recent lows, and in our view, even if rates were to move lower in the near term, the upside in the fixed income markets remains limited, and it's difficult to justify repositioning portfolios to pick up the next 20 to 30 basis point move lower. In addition, valuations within most sectors of the fixed income market still appear rich relative to historical averages. There's an asymmetrical risk-return profile within fixed income in our view, as the downside in bonds currently outweighs the limited upside potential. Furthermore, if the U.S. were to come to a resolution on trade or we began to see an uptick in economic data, rates could reverse course rather quickly. So in summary, the market's expectations for Fed policy have changed significantly, with global and domestic economic growth slowing, the yield curve inverting, inflation running well below the Fed's 2% threshold, and of course, continued uncertainty on the trade front. As a result, the market is now pricing in 2 rate cuts in 2019. Historically, equity market returns have been mixed after the first rate cut, and while yields may move slightly lower in the near term, we believe the upside in the fixed income markets is rather limited at this point and outweighed by the downside risk should rates reverse course. This brings us to the close of today's Fairport Flash. As a reminder, our goal at Fairport is inspiring families. As a member of the investment team, we strive to do this through a long-term diversified approach. If you would like to discuss any of today's general topics in more detail, please reach out to your Fairport team. Thank you for listening and look for the next Fairport Flash in about a month.
Fairport is a group of investment professionals registered with Hightower Securities, LLC, a member of FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinion, news, research, analysis, prices, or other information contained in the research is provided as a general market commentary. It does not constitute as investment advice. Fairport and Hightower shall not be in any way liable for claims and make no express or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements and errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Fairport and do not represent those of Hightower Advisors, LLC, or any of its affiliates.